Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you kind of the selection process that I use. It's kind of an option strategy guide. And basically what I look for is, to look at option strategies as to when, how, and which one to use for the best results in certain market conditions. So we've been, in a big hard kind of correction mode here to the downside on the broad market indexes. And one stock I've been following here, watching quite a bit, has been NVDA. So basically when you look at NVDA, you can see that it's had the big pullback and it held down here to this is a 100 period moving average, and then we started getting a reversal. You can see right here this arrow reversal came up into that 382 retracement right here and spent about 4 or 5 days just consolidating there. And then finally today the markets just overall had a big push to the upside, and we had a nice really big rally and a big breakout on NVIDIA. So we had moving average cross that I like to follow here, 513, and we had a nice moving average cross here on the 4 hour. So we've plowed through the 50 simple moving average and came up to the 618. So testing into that. Now we could get a little bit of a pullback here tomorrow, but the type of trade setup, one setup that I like to use is what we call a calendar diagonal. So what the calendar diagonal will do for us is it'll, we can work the trade. If it doesn't go straight up from here and keep going, or if it pulls back, we can adjust the trade and kind of like a covered call and amortize the trade while we're waiting to take it to the next level. So here's the trade setup and how that we could, amortize and use this trade to adjust it if we need to. So with this trade, what we did, we went out to the 5 November series. So if you right here, 5 November. So we went out to this 22 days out and bought the 215 call right here. And so then to hedge it, reduce our risk, what we did is we sold against it the October 22 series, 8 days expiration, so faster accelerated theta decay, sold the 220 against it. So what we end up with is this what we call a diagonal, calendar diagonal. So long the 5 November, 215, short the 22 October at a debit cost of $5.40 or $540. Now the thing that's really great about this particular type strategy is that if we don't get a follow through in a move next week to our target here at 220, we can then just keep the credit received like a covered call and then roll it to the next series. So for example, long the 215 here, the November 5 at like $8.16, and then sold against it the 22 October for next week's expiration, 220 at 276. So if we don't get the 220 next week, we could keep that whole $276 there. And then what we do is we'll roll down and sell the next series. We would sell down here the 29 October, maybe 220 strike right there, bring in 435, and just that will amortize then your long dated down by the amount that you receive here or keep of 275. So it's a great strategy, kind of like a covered call, sometimes called a poor man's covered call. And I hope this helps. And if you'd like to learn more about these types of strategies and all of the different option variation strategies that we use at PowerCycle Trading, come visit us. Good luck trading.